Welcome to Part 8 of my Technical Analysis Foundation course, Structuring Your Analysis Framework. We're going to start the final lesson of the course with a huge thank you to our sponsors Phemex. Normally, I would have charged hundreds of dollars for this course given the amount of time it took to make and the quality of information, but thanks to Phemex, the entire thing is free. So we're going to spend some time now to talk about them and why they are my top choice of exchange. So here are the reasons why you should be swapping to Phemex 300,000 transactions per second. This means that your probability of getting the infamous order submission error is minimized. So make sure you're using the fastest derivatives and cryptocurrency exchange there is. Mobile app, not much needs to be said. Here, they have a fully functional mobile app with a fantastic user interface that lets you trade on the go. To say they have an amazing team is an under-exaggeration. These guys are ex-Morgan Stanley execs and they know exactly what they're doing, bringing them knowledge from traditional markets over to crypto. A lot of people in crypto value their privacy. This makes no KYC extremely useful, especially for an exchange that has up to 100x leverage. Make sure you use leverage sensibly. Next, there's a wide selection of pairs. You can trade spot pairs or contracts. They even include non-crypto assets like gold with plans to introduce more. You get up to $72 free for signing up. If you like free money, this is also a perk. And I saved the best till last, a game-changing update they brought out, which can save you a fortune on fees. They now allow zero-fee spot trading. I've done a video breaking down how this can save you a lot of money, so make sure you check it out if you are currently spot trading. Phemex are continuously pumping out updates. They have huge plans for the future. I am very confident that these guys are going to be one of the biggest cryptocurrency exchanges. So if you are interested in trying them out, you can find a link in the video description. Congratulations on making it to the end of my Technical Analysis Foundation course. We have got a lot of content to cover in this final lesson. I'm going to start by showing you how to structure your trend analysis framework. Then we're going to go into a support and resistance framework. I'm going to talk about how you can add secondary frameworks on top of this core framework. We'll talk about selecting the right timeframes. Finally, we'll put it all together and talk about your next steps. So I'm going to go over the usual disclaimers. This video is for entertainment purposes only. Any information spoken or written should not be interpreted as financial advice. Carry out your own independent verification of facts and data. Don't just take my word for anything. I am not a financial advisor. I do not hold any relevant qualifications. If you seek financial advice, speak to a professional. And finally, trading is an extremely risky activity. Your trades are your responsibility, so trade at your own risk. What is a technical analysis framework? Our technical analysis framework is our personal set of rules and guidelines for analyzing the market. Personal is a key word here. What I'm going to present to you is my personal guidelines on how to structure a good framework. From this, you can take what works for you and ignore what doesn't. Here are the different components of my technical analysis framework. First, I like to create a trend analysis framework. This gives me the ability to consistently determine the state of the market. Every single time I open a chart, I will use the same strategies to determine what the trend is doing. Then we're going to talk about creating a support and resistance framework. When I select a level as a support and a resistance, I don't want to be randomly assigning value to it every single time. I want to be able to value these levels in a consistent manner. Then I'm going to go over potential secondary frameworks you can use in conjunction with the core trend analysis and support and resistance frameworks I like to use. And then finally, we'll talk about selecting timeframes. Structuring your trend analysis framework. So step 1, select your primary tools. First, moving averages. These are one of my favorite tools for analyzing trends, and I did a very in-depth lesson explaining how to use these tools. So if you wish to include moving averages in your trend analysis framework, you need to select which moving averages you want to use and how many. For those of you who are a bit more discretionary as traders, you may want to incorporate candlestick analysis in your framework. Fibonacci retracements are very useful in conjunction with moving averages and candlestick analysis. Finally, volume and open interest can be useful tools as well. And do not forget you can use any other tool you enjoy using for trend analysis in conjunction with these, even ones I have not covered in this course. There is no right or wrong way to do this. Initially, we want to build consistency above everything. So step 2, once we've chosen the tools we're going to use, we're going to create the framework itself. In example 1, I'm going to present to you a very simple framework using only moving averages. I've selected 3 moving averages, the 20, the 50, and the 100. So now every single time I open the chart, I will have a consistent way of determining the market conditions. I will know if the 20 is above the 50 and it's above the 100, that the trend is bullish. I'll know if the 20 and 50 are crisscrossing or there isn't much distance between them, but they're both above the 100. The trend is a rather weak bullish trend, so bullish neutral bias. In an instance where the 20, 50, and the 100 are crisscrossing and there's no clear trend, I'll know it's neutral. In an instance where the 20 and the 50 are crisscrossing below the 100, I'll know there's a bearish neutral trend. And if the 100 is above the 50 and the 20 is below the 50, I'll know there is a strong bearish trend. This would make it extremely easy for me to record trades. It'll make it extremely easy for me to backtest trades. Why? Because it's consistent and I can do the same thing every single time. Now let's take a slightly more complicated example. Say your system is extremely sensitive to the current market conditions. You may want to introduce more variables, whereas last time we had 5 different market conditions. By adding open interest alongside moving averages, we now have 10 different market conditions. When open interest is confluent with our moving averages, we assign more strength to the argument. Now I hope you can see how this framework allows us to be consistent. Like a pilot, we can go through a checklist every time, the first part being determining the trend. Here are a few more possible combinations you can play around with to decide which ones you want to use. You can combine moving averages with the Fibonacci retracement tool. If you want even more complexity, add open interest and volume on top of that. You can combine candlestick analysis with the Fibonacci retracement tool, and you can even combine moving averages with candlestick analysis. Your only limitations are your creativity and your understanding of the tools themselves. Structuring your support and resistance framework. This is going to be a bit more difficult than our trend analysis framework because there is a lot more discretion when it comes to this. I like to go about a support and resistance framework by creating a value system. So I use different things such as the number of data points, quality of data points, the length of time of an argument, psychological levels, and you can use any other factors you deem important to create a value system. In an example now, I'll show you how this value system would work in practice. Now we're going to analyze the $9,500 to $9,300 support area marked out over here. So first we're going to calculate the number of data points. I'm going to add 1 point for every data point there is, then I'm going to subtract 1 point for every deviation. So let's look at the data points. Here we have one where it acted as a resistance before it flipped. Here we have our second one, then we have our third, fourth, fifth, sixth, and 7th over here. 7 data points, and deviation, I don't see any data points which disagree with this level, so no points taken away for deviation. That leaves us with 7 points for 7 data points. Next, quality of data points. I'm going to subtract 1 for a messy point, and I'm going to subtract 1 for weak context. So 1, 2, 3, 4. These 4 points are messy in my opinion because these don't quite reach this area, and these, while they didn't close below our region, the wicks did go through. We're going to subtract 4 points because they aren't clean data points. Next, we're going to subtract some points for weak context. If you remember, is what happens after we interact with our level. Here, the price is progressively getting lower and lower every time. These 2 data points are quite significant for me. I'm going to use my discretion to subtract an extra 2 points for weak context. That puts us at -5. Next, the length of time of an argument. I'm going to set the max for 3 points over here, and it's going to be discretionary. This area is held for several months. It's longer than the average support area I tend to analyze, so I'll be giving 2 discretionary points for length of time of argument. That puts us at +2. Then psychological levels. I don't see 9,500, 9,300 as a key psychological level, so I won't be adding any points for that. So that leaves us with a final score of 4 out of 10. This is without a doubt an area of support, but it is below average in strength. Now, this is an example I've come up with to show you guys how you can create a value system. By this point in the course, hopefully your intuitive understanding of the data will let you create your own value system. And through this, we have a consistent method of assigning value to our support and resistance arguments. Now that we have our base value system, we can expand it a bit more. We can use certain indicators that can be confluent with our support or resistance levels and incorporate them as complementary parts of the value system. For example, we could add a certain number of points if the support or resistance level is confluent with a certain moving average or Fibonacci level or anything else you'd like to include that may not necessarily be from my course. Step 3. So now we have our base value system, we need to determine our invalidation and breaking conditions. Under what conditions will we consider a support or resistance level broken? Will it be one or two candle closes above your level? Will it be a candle close accompanied with increasing or decreasing open interest and volume? Will it be a candle close accompanied with a moving average cross? Or will it be a candle close after a move that hasn't retraced more than our 0.238 Fibonacci retracement? You can see now why there's a lot of work to be done this lesson. You need to sit down and create your own framework. And if you don't understand the tools well enough to come up with your own, then you're not ready to create your framework yet. Do not build your trading on a weak foundation. Take the time to understand what you're doing. Next, under what conditions do you no longer consider a support or resistance level significant? Will it be a failure to retest after it's broken? Or would it be when your value system drops to 0? So when your argument drops to 0, you no longer consider that level significant. I'm just giving you ideas here. The end result has to be something you've come up with yourselves. And with that, you will have a framework for analyzing support and resistance levels. Let's cover some secondary frameworks you can use alongside your primary ones. You could include a framework using oscillators like the relative strength index or Bollinger Bands. You can use Elliott wave theory if that appeals to you. Some traders like to study statistics on certain months of the year, days of the week, or times of the day and incorporate that into their systems. Also, if you're trading multiple similarly behaving assets, you should have a system for analyzing liquidity to make sure the market has enough liquidity for your orders. Next, we're going to talk about selecting our timeframes. While this is important for our analysis framework, it's something I'd like to cover in a lot more detail in a future psychology course because your personal psychology and lifestyle is a huge factor when deciding which timeframes to trade on. So selecting timeframes. Now I've explained to you multiple times throughout this course the difference between timeframes. When you go to higher timeframes, data becomes more significant, volatility decreases. At lower timeframes, data is less significant and volatility increases. So you're going to have a lot more opportunities on lower timeframes and you're going to have a lot less opportunities on higher timeframes. Personally, I like to trade on lower timeframes. I'll get into positions multiple times a day. I don't like waiting extended periods of times for positions to close because I cannot stop thinking about a position once I am in it. This is why psychology is extremely important when trying to select your time frame, but for the purpose of this course, you can select what time frames you like based on what type of trader you want to be. Now, do you want to be a day trader and trade time frames under the 1 hour? Do you want to be a swing trader, trade time frames from the 1 hour to say the 1 day? Or do you want to be an even longer time frame trader and trade weekly and monthly charts? That's up to you. Experiment with both and decide which one you want to use. And then I'd recommend selecting 2 complementary time frames. Now, a higher time frame can be extremely useful for trend analysis and also pinpointing significant support and resistance levels. Then you also want a lower time frame to complement this, help pinpoint support and resistance and validations and breaks. And now we put it all together. Here's your checklist. You want to select your analysis timeframes. You want to have a trend analysis framework which you can perform on these timeframes. You want to have a support and resistance analysis framework, a value system in which you can assess the importance of different support and resistance levels, and you can accompany this with any secondary analysis tools you want. And you will go through this checklist every single time you analyze the market. This is a complete technical analysis framework. Once you have built your technical analysis framework, congratulations, you have completed my technical analysis foundation course. Your next task is to translate your technical analysis framework into a trading system. You will use your framework to come up with hypotheses for entry and exit strategies. You will then test these in the markets and attach correct risk management to them. Once your data shows that you are profitable, you can then enter the market with your strategy. Of course, you also have to make sure you have the correct mental framework to execute your trades. A lot of you will be able to take what I've taught you and turn it into a trading system by yourselves. For some of you, however, I'm sure it'd be very helpful if I built more courses to show you how to manage risk, how to develop systems, and also how to build your mental framework and master trading psychology. Well, as I've said every single lesson, I would absolutely love to make more courses for you, and I would also love for them to be free. If you want more future courses from me, sign up and try out Femex with my link.